So let's describe about the risk objectives of a client. A client's risk objectives can be stated in two forms: absolute risk objective and relative risk objective. For example, a client may desire not to suffer any loss of capital in the next 12 months period, or client have desire not to lose more than 10% of the capital in the next 12-month period. This type of risk objective are absolute risk objective. On the other hand, the client may have a desire to achieve returns within 5% of the return to the benchmark stock index. This type of risk objective are called relative risk objective. So in order to determine the risk objectives, we need to understand the risk tolerance of the client. A client's risk tolerance is a function of ability and willingness to take risk. An ability to take risk of a client can be measured based on objective factors like how much time horizon the client has, or what is the expected income of the client, or the level of relative wealth of the client compared to his or her liabilities. So if a client has a long time horizon, higher expected income, and high level of wealth compared to his or her liabilities, then that client has higher ability to take risk, or we can say above average ability to take risk. On the other hand, willingness are determined based on subjective factors. It depends on client's psychology. For example, investment managers might ask a lot of questions to the client, and based on the response, investment manager determine whether the client has above average willingness or below average willingness. For example, there are some risk attitude questions. Here we have shown 5 questionnaires that determine, based on the response, that determine the willingness or risk attitude of the client. So each question has 4 options: strongly agree, tend to disagree, and strongly disagree. So investment manager put a rating of 1 if strongly agree, rating of 2 if tend to agree, rating of 3 if tend to disagree, and rating of 4 strongly disagree. So based on these 5 questions, the total number of points is the maximum number of points is 20 and the minimum number of points is 5. So once the investor asks these questions, client response, based on client's response, investment manager determines whether the client has a higher willingness or a higher willingness to take risk or not. So here are some of the questions, like: investing is too difficult to understand. I'm more comfortable putting my money in bank account than a stock market. When I think of a risk, the term loss comes to my mind. Making money in stocks and bonds is based on luck. In terms of investing, safety is more important than returns. So if a client scores, for example, strongly disagree, the point is 4. Higher score indicate greater risk tolerance for a client. So based on the willingness and ability, a client's risk tolerance is determined. For example, if a client has above average ability to bear risk and above average willingness to take risk, then the client has above average risk tolerance. If a client has below average ability to take risk and below average willingness to take risk, then the client has below average risk tolerance. A client might have above average willingness but below average ability, then resolution is needed, which means investment manager need to have a talk with the client. The client may not have higher ability to take risk, so having the higher willingness to take risk may not be good for the client in the long term. So investment manager need to suggest the client he needs to reduce his willingness. Same goes for when the client has above average ability but below average willingness. Last risk objective, the investment policy statement also describe about the return objectives, and like risk objectives, investment clients' objectives can be absolute or relative. So a client might want to achieve a particular percentage rate of return. For example, a client wants to achieve 8% rate of return in the next 20 years. So those type of return objectives are classified as absolute return objective. If a client has a desire to outperform the benchmark stock index by 1 percentage point, so here the client wants to outperform the benchmark stock index. So the return objective is relative.